A warm welcome to our webinar. We're thrilled to have Nick Edgerton from Stewart Investors to talk with us about their worldwide sustainability fund, as well as recent market events. A big welcome to all of our clients this morning, and an even bigger welcome to guests that are joining us on this webinar as well. As everyone knows, these are tricky times in the world at the moment, particularly in Victoria. We hope that you're coping as well as possible, particularly if you're under stage 4 restrictions. All of our staff are working from home at the moment under stage 4 restrictions, and they send their very best wishes to all of our clients. We also appreciate all of the clients that have been checking in on our wellbeing over this time as well. We greatly appreciate it. We thank everyone that submitted questions. We're going to try and get through as many of them as possible today, but if you have any particular questions that we don't cover today or that arise after the presentation, please let us know or get in touch and we can certainly go through those. So before I get underway with Nick, I just wanted to go through our disclaimer or show everyone our disclaimer. Obviously, today, this is general advice only. This is not specific to anyone's circumstances. So that's really important to note. As much as we like the Stewart Fund, you can't put all your money into it, okay? And certainly you've got any questions about the investment in particular, it's really important that you seek advice. So as everyone knows, the 2019-20 financial year was a very challenging year for investment markets. International shares produced a respectable return of 5% for the full financial year. So that's from the 1st of July 2019 through until the 30th of June 2020. But this number, it really masks the volatility that occurred over that 12-month period. And as everyone can see in this chart here, the MSCI, which is a general representation of world share markets as a whole, actually fell by 24% from late February to late March. And it's really important to note in that 24% that it's a little bit masked by the effect of currency. Currency was certainly a kicker for Australian-based investors. If you look at the return of the S&P 500, which is a broad measure of US shares, that actually lost 34% over that same period of time, which is the green line on the chart. Now, pleasingly, the red line is the Stewart Investors Worldwide Sustainability Fund. That held up particularly well over that volatile period and only lost 15%, which is quite an astounding result over that period of time. Over the last 7 years and 5 months, ended 31 July 2020, the fund has produced a return of 14% per annum compound, which is in line with world share markets, but with 11% less volatility, which is quite impressive. So I'll introduce Nick Edgerton, who's an investment analyst with Stewart Investors. Nick joined Stewart in 2010, so he's been there 10 years. I can only imagine the last 12 months has been the most interesting. And he's responsible for generating investment ideas for the worldwide sustainability funds across all sectors in emerging markets and developed markets. Good morning, Nick. How are you?
Thanks very much, Patrick. Good morning. I'm very well.
That's good. How are you coping with lockdown at the moment?
It's going okay. I'm in Sydney, so we are actually back in the office 1 or 2 days a week. Today's one of my days at home. But, you know, we feel for everyone in Melbourne. We know we're quite fortunate to have so far escaped a second go.
Touch wood. Now, I'm not generally inclined to ask about a portfolio manager's background, Nick, because they're normally pretty typical, but you've certainly got an interesting background. You obviously entered finance and then went across to academia and did a few interesting things and came back to funds management a little bit later on. So I'm sort of keen to explore that because you don't often see people come back from academia to funds management.
Yeah, sure. And it's actually quite common in our team not to be vanilla trained and career length finance professionals. But I did study economics and finance at university. I was particularly interested in the Asian economies. I went through university in the early 90s. It was an interesting time for Asia. I worked in the finance industry for a couple of years, but was fairly discontent as a young graduate in what I saw and what I was involved in. I was actually much more interested in developing economies and how the world would evolve, I guess, within particularly the environment and political constraints. So I went back to university and studied a pretty wacky postgrad degree in the late 90s called ecological economics, which was fascinating. But it led me going into lecturing in environmental economics, and actually from there moving into more of a public policy role in the Australian federal government, working in the economics part of the Environment Department at the time. I then got led even further astray because they happened to manage the Antarctic program, and I found myself working on that for a couple of years, including a summer at Casey Station in Antarctica, working on environmental management systems. And then really started to move back full circle, working back in Sydney, particularly on a lot of water economics and sustainability around water issues for local utilities here, doing a lot of water pricing of water options longer term for Sydney, and then moved back into finance, doing some work around sustainable investment as a consultant before joining AMP Capital late 2004 in a sustainable investment team, and then moving into Stewart Investors not long after that. So I've been in sustainable investing for about 15 years and really sustainability and economics broadly since leaving university in 95.
Interesting. Do you get an invite to the fund manager lunches, Nick, with a background like that? It's very unique. There's no CFA or Master of Applied Finance. It's a bit diverse.
Strangely enough, no, there's no none of that stuff.
Not surprising. Now, can you tell us a little bit about Stewart? Without bringing up another fund manager's name, lots of our clients are familiar with Magellan. Magellan is almost a household name here in Australia. Not many clients have heard of Stewart as a business. Firm was founded back in 1988, so it's over 30 years old, and manages over 20 billion Australian funds under management. So could you give us a little bit of a background to Stewart and their history?
Yeah, sure. And it originates from what is really a fund management powerhouse of Edinburgh in Scotland. And I was based there for a few years as well when I first joined the team. So its precursor was Stewart Ivory, a small boutique, which in 1988 was running Asia Pacific investment funds out of Edinburgh. And over time, through the journey in Asia, moved into emerging markets funds. In around 2005, one of the younger members of the team who still runs our team, David Gates, set up an Asia Pacific Sustainability Fund. He was particularly interested in development economics. We had some Swedish institutional clients who were keen to start it up, and so they backed us with our first Asia Pacific Sustainability Fund in 2005. In 2009, we moved into an emerging markets sustainability fund. And around that time, we were starting to observe that a lot of these regional constructs in investing didn't make a great deal of sense. When we went to see companies in EM or Asia Pacific, they were competing with the developed world, and really barriers were being broken down. So we decided we needed a fund where clients could say, I want to allocate $1 of capital wherever those companies are best positioned. And so in 2011, we started our worldwide sustainability fund. I started as co-manager of the fund. In early 2016, I took over as lead manager of the fund. And now it's evolved to a team of about 20 investment specialists, or analysts, I should say, managing about $21 billion, and our worldwide strategy managing about $3.3 billion.
Can't imagine why you would want to leave the Scottish winters, Nick, and return to Sydney. It just puzzles me. How did you go with the weather in Edinburgh?
Yeah, it's pretty challenging. The summer's actually probably harder than the winter because it never actually arrives.
Interesting. Now, this concept of stewardship with investing, when our team's spoken to you guys, you're very passionate about stewardship as a concept. I think lots of fund managers get very focused on buying businesses on the right multiples and business models and these sorts of things. Can you talk to us about stewardship and how you guys think about stewardship when it comes to investing?
Yeah, sure. Steward happens to be steward happens to be the old Scots word for steward. But we try and keep investment fairly simple. We believe a lot of it's around trust. Ultimately, we need to build up trust of our clients so that they will hand over their hard-earned dollar for us to invest. And where we invest that money needs to be handed over to someone else that we can trust is going to look after it for a lengthy period of time. So there's two aspects of that, really. The role of us as stewards in our industry, but also the companies we invest in. So first of all, us in the industry, we think there's a key role in focusing on how we allocate capital for productive purposes for the longer term economy. Obviously putting clients first, and we've actually drawn up over 10 years ago a Hippocratic oath that naturally we ripped off the medical industry in part, but have really tried to identify some issues that we have with our industry around focusing on purposeful allocation of capital, sober, sound judgment in decision making, not knowingly harming others, and remembering that owning shares actually has responsibilities as well as rights. In addition to that, when we're actually handing over the money to companies we invest in, we want to make sure that there's great signs and track record and evidence of integrity. Ultimately, investing around the world can be quite dangerous at times. There's many places without decent rule of law, or where regulators or governments can interfere significantly with companies. I think we often forget that in Australia, after many decades of good times, that when things go wrong, companies can get interfered with. And so what we want to see is that someone is running the company who has proven through cycles, through difficult times, to make the right decision for that company, to not rip off shareholders, because it's easy to do to minority shareholders, and that can be through allocating capital or capital raising, through to siphoning money legally or more coercively out of a company. And that those people have the long-term future in mind for the company, not merely the next quarter, not running it at 100 miles an hour for the next quarter. And so we ideally like to find someone that we are economically aligned with for the longer term. It often resides in companies where people have their name on the tin, so to speak, or there may be intergenerational control of the company. But ultimately, stewardship is about finding trust. Trust from our clients that we're doing the right thing every day, that we're not just out there speculating or trading Bloomberg tickers, and trust in the people we're handing the money to, that they're actually going to take care of minority shareholders like ourselves.
Yeah, find this really interesting, Nick. So stewardship, without sounding clever, it's more than just corporate governance, isn't it?
Yeah, it is much more than corporate governance. And what you've seen is the world is gravitating towards the Anglo-Saxon model of corporate governance around independence. However, we've seen that is not a panacea to corporate collapse or scandal.
Yep.
We've seen that you can still have shareholders taken advantage of and poor behaviour under just pure corporate governance codes. What we prefer to see is really strong signs of people doing the right thing by those shareholders. And it can emanate either from signs that are, or the bad behaviour can be shown from signs from someone running a company taking too much money out of it, through to strong related party transactions, through to aggressive accounting that artificially inflates their earnings numbers short term to give the impression the company's in a better position than it actually is, or fiddling with working capital to do that. There's many, many ways you can do it. And so we try and work out who's actually running a business honestly, with integrity, because ultimately if they will cut corners with their accounts, with the way they run the business, with the environment, with local communities, there will be nothing to stop them cutting corners with shareholders.
Interesting. Now, we're going to talk about some stocks later, but I'm keen to understand the concept of stewardship when you're looking at potential investments. Does bad stewardship remove a company from your investment universe? And further to that, how much, I know it's really hard because it's going to depend on the business, but how much time do you spend looking at that stewardship piece versus, say, the financials and the valuations and those sorts of things? Yeah,
so poor stewardship does really remove an investment option for us. Ultimately, we've seen many times where we can be taken advantage of if we're not aligned with those decision makers behind the business. And you see it all too often with companies, for example, unable to generate profit growth, and so doing some financial engineering to buy back shares instead, leveraging a business up, putting it at longer term risk, but just to get short term numbers that might meet their options targets for their payout, for example. Or another classic we see a lot of the time in the developed world is real assets in the business, like a brand or properties actually being owned outside of the listed entity by the founder and rented by the listed entity back into the company at high rates. Or even worse, there was a classic example in Hong Kong in the last 2 or 3 years, a business called Hanergy, where a solar panel business was briefly made their owner the richest man in China, only to find out that over 75% of the orders he had fabricated, and as the stock price collapsed about 80%, he had shorted the stock all the way down and made a fortune out of it.
This got quite a bit of media coverage, didn't it?
Yeah, that's right.
Yeah, I remember it.
And it was briefly frozen on the exchange, and it just goes to show how careful you actually need to be in countries that have rules and proper governance procedures. So how much time do we spend on this versus everything else? It's hard to put a number on, but ultimately it is really one of the core focuses of what we do. We need to be comfortable that both a company is well stewarded and the quality of the franchise they're running is high quality and the financials of the company are sound. And then on top of that, we want to make sure the business is well positioned for long-term sustainable development. So in rough terms, there might be a quarter of all of that. And of course, there's valuation as well. Although I'd argue that if you're investing longer term, the evaluation part is probably a bit easier and probably less taxing than if you're looking at trading businesses quarter to quarter around results.
Understood. Now we're going to jump from stewardship to sustainable investing. So obviously the fund's called the Worldwide Sustainability Fund. There's been a lot of interest in this space. The interest is growing. Can you talk to us about what you look for in terms of when investing sustainably?
Yeah, of course. And it has become a real acronym soup. ESG, SRI, RI, impact investing.
We don't need more acronyms, but we've got them, Nick.
Yeah. So we simply look at companies which are going to contribute to a more sustainable pathway of economic development and can profit along that pathway. So what does that mean? What it means is that we think over coming decades, economies will face carbon constraints, fewer environmental resources, waste will become an increasing problem, social issues around affordability of healthcare, around inequality, and around diversity issues as well, will all increasingly challenge companies. So we think that companies who recognize this lens that they're operating in and whose purpose as a business actually fits quite well with promoting the world's economies in that lens and can profit from it are going to be well positioned to provide good returns to shareholders. So to flesh that out a little bit more, we're looking at, for example, healthcare industries that can provide accessibility. So we've invested in a company in Germany for many years called Merck. It's different to the Merck in America, but they're a leader in many vaccines in the developing world. So, for example, a parasitic disease called Bilharzia in Africa, they're the leading treater of and treat dozens of millions of Africans every year with an affordable vaccine. Obviously, we're looking at businesses that are involved in cleaner energy. We're looking at not just wind turbines and solar panels, but the incredible ecosystem that sits behind them. So we've been invested for a long time in a US listed company called Ansys, which is a software simulation business that the engineers and designers panels and automobiles as well for looking at efficiency in electric vehicles are using. So they're the leader in providing the software to help innovation in those spaces. We're looking at consumer good companies that are more necessary than luxury. So we're not so interested in the handbag companies or the sports cars companies. But companies like Unilever, which is the global leader in providing things like soap and basic sanitation needs, and have now reached out to 1.2 billion people in the developing world around hand washing and sanitation. And then lastly, another one that we perhaps don't recognise in Australia, being Australian investors, is actually sensible and equitable financial services companies. And there are some out there in the world. For many years, we're investing in a fantastic Swedish business called Svenska Handelsbanken, where the bankers earned no bonuses, there were no targets, there were no KPIs.
They can't call themselves bankers, Nick.
I
noticed you grin when you made reference to Australia.
Yeah. Yeah, well, you know, I mean, a lot of global investing is interesting because it can be. Australia is a very different economy in many ways. I mean, over there they were doing church buyer banking, which means you were responsible for the loan and the savings of accounts to the next church buyer. And the person who wrote the loan was accountable for the loan. There wasn't a central pocket creating these targets or marketing or dealing with accountability. They devolved it down to the ground, and unsurprisingly, they have the lowest non-performing rate in the world. So they don't write loans that go bad because they're taking care of them. And you know, we're actually involved in a couple of Indian banks as well, where they're really rolling out very fairly priced mortgages to people for the first time ever in rural India, which is an amazing market. So I'll just lastly say. Actually, no, two things. First of all, what we are not doing is we're not going out to invest in every renewable energy business or clean tech business out there. As I said, there's lots of segments in the economy that we need. We need basic consumer goods. We need financial services. So there's the full suite. At the same time, there are no perfect companies. So there's problems, and we'll refer to them as we go on, but there's problems with every single company we invest in. And so we think that's where the responsibility of engaging and voting company stock comes in, and we try and build relationships with companies over time to nudge them to recognize some of these risks and capitalize on them in terms of the way they act.
Interesting. Now, just sort of linking with that sustainable concept, I just want to ask you about Project Drawdown, Nick. So I'll let you get started, and I'll also share a slide as well about Project Drawdown.
Yeah, sure. So Project Drawdown really started for us because we were struggling a little bit. Thanks for putting the slide up, and I'll try and, it's very busy, I'll try and describe it, but we were struggling with how we answered the question of the climate impact of our portfolio. And most in the industry had been leaning towards what was called the carbon footprint. And we were doing that, but the answer we got was that our portfolio was 75 to 90% lower climate footprint than the index. That actually doesn't tell us anything about achieving the necessary climate reduction goals for the world between now and 2050. So what we tried to do is perhaps disclose better how we thought we were both impacting the climate, but also importantly investing in solutions that would help. So Project Drawdown is about 6 years old. A couple of scientists, Paul Hawken and Amanda Ravenhall, came up with it. And what they do is use scientific studies or peer-reviewed studies to do an analysis of a large number of solutions that can actually help to getting us down to 1.5 degree target. And they came up with about 80 climate change solutions which are consistent with the Paris Agreed climate goals. What they do is they estimate the reduction potential of these emission solutions, and they are quite broad ranging. So it's not simply put a load of solar panels on your roof. It's everything from educate women, reduce food waste, improve telepresence like this and recycling, infrastructure, water and energy. There's a whole range. So what we did is we looked at where we were invested in our portfolio across these, and we found that we were consistent with, our companies were consistent with 33 different climate solutions. 2/3 of our companies were involved in business contributing climate solutions, which again it points to the fact that we're looking at more broadly than climate change when we're investing. We're looking at sustainable development, so not everything is about climate. But what we've found is, as you can see from that slide, for example, some of our biggest contributions are through the companies that are, for example, the 7 companies we're invested in that are helping to reduce food waste, or those in the supply chain that are involved in utility scale solar PV. I mean, we own no direct PV manufacturers, but we're involved in companies that enable photovoltaics, and they enable the growth of that segment. We're not invested in any automobile companies or battery companies. We're invested in electric vehicles through a large proportion of our companies, and that's from the company that is involved in the adhesives of the battery packs going into electric vehicles, through to Infineon, which is a German listed company that is the leader in power management for energy, so for electric vehicles in terms of their microchips, their semiconductors. And again, the innovation and development there around improving the output and the range of electric vehicles is based on a lot of the work by Infineon, but we're not invested in trying to pick the winner of which automobile company will come first. So through Drawdown, what we're really trying to do is represent the portfolio with how we are investing into a broad range of solutions that will help the world achieve its climate change requirements. And as I said earlier on around what we mean by sustainability, all of these companies we passionately believe, because of this positioning, are going to profit very, very well. None of them are non-for-profits. None of them are doing it because they're trying to feel warm and fuzzy. They're doing it because it's making them fantastic returns, and they're in growing industries with additional support from regulators and consumers going forward.
Interesting. Now, one of the things that you really highlight in your literature, Nick, is around the concept of investing in family-owned businesses. Can you talk about what draws Stewart to investing in these family-owned businesses at the expense of other types of businesses? And maybe give us a few examples of family-owned businesses that you've got in the portfolio at the moment.
Yeah, of course. And this touches on a couple of things I've mentioned. Firstly, around what we've seen in Australia historically. And I think you could argue our family businesses, family listed businesses in Australia haven't always performed exceptionally well for shareholders. Again, outside in the sphere of global investing, there are many, many family businesses, many, many listed controlled companies, many of them with fantastic track records, some going back decades, some several hundred years. And ultimately, it also touches on what I mentioned around corporate governance and the world moving towards this Anglo-Saxon model of corporate governance. What we're trying to find is evidence of a steward who is economically aligned with us, who is shown through history to make the right decisions for shareholders. We don't believe a board full of independent directors gives you that decision making, and there's been a couple of great cases even this week in Australia that perhaps back that up. We are looking for, through the cycle, through the good times and particularly the bad times, how have decisions been made that has been the right allocation of capital for the company? How have they looked after local communities? How have they considered the environment? How have they interacted with regulations? And what we tend to find is that this is often most powerful when a business either has the family name on the business, or it's being held or stewarded by the people, the management running it now for the next generation. And so to give you some examples, I mentioned Merck in Germany. That started in the 17th century as a pharmacy business. It's been very well looked after by the family who still own 75% of the stock in Germany for 350 years. It's still providing fantastic shareholder returns now and positioning itself for the long term. This is a pharmaceutical business primarily, where they have unlimited liability. So one thing about listing in normal company constructs is you get limited liability, and pharmaceutical companies get limited liability. and are obviously fined very, very heavily because many of them have misdemeanors around the way they market or the way they use their drugs or medical devices or implants or the like. If you are the family with your name on the business and you're running it for hundreds of years, and you're the current generation looking after it to pass on to the next generation, the mindset and the way you run that company will be very different to if you are a manager in what's called a free float company, so all of the stock are available on the stock market. And we know the average tenure of a global CEO is around 3.5 to 4 years. You're incentivized to maximize next quarter's earnings. You're incentivized to increase your options based on that. And the way you're running that business is very, very short term. You have little mind for what happens in 5 or 10 years' time, let alone when the cycle turns next. So we see changes in the way R&D occurs through cycles, the way balance sheets and cash and debt is managed through cycles, the way companies can patiently build up their place in a market. So some of the ones we're invested in include Vitasoy, which is a soy milk-based business, which is currently on the 2nd generation, started in the late 1930s in Hong Kong. The beauty of this business is that as Mr. Lowe, who started it, the chairman's currently the son of Mr. Lowe, but Mr. Lowe, who started it, went bust once already during World War II, learned from his mistakes, revived the business, got it up and running again. In the 1970s, handed over or gave his 3 sons enough rope to hang themselves. They all went off into alternate products. One was an alternative soy business. One was a TV meal business for Chinese, and all of them failed. Again, they made mistakes and worked out. They learned how to walk first before running, or as he says, you can't leap until you walk. Another business is that I'd highlight as Kotak Mahindra Bank, which is a bank in India that we're invested in. Kotak Mahindra was set up by Mr. Kotak, Uday Kotak. His name is on the branch of every single bank. And what you need to understand when you talk to him, the mindset of how he runs that business is very, very different. So if you're one of 100,000 employees who's in middle management able to make decisions about a large, free float bank in Australia, you're thinking about your own personal career risk. You might be thinking about the ladder and how you climb it, or you might just be wanting to do a good job. Mr. Kotak's name is on everything, every loan that's written, every business deal they go into, their decision to expand into rural India. The decisions affect him and his family. The same goes for another business in India, Godrej Consumer. Godrej Consumer was started by Adi Godrej, who has passed on the business to his daughter, Nissa Godrej, which is quite unusual in the Indian context. He avoided passing it on to a male heir. And she is very well educated in the US, professional manager who, again, his name is on the business and is looking after the business for the next generation. One of their key products is personal insecticides. They sell into the Indian states that have the highest rates of malaria, and they've had a great contribution to reducing malaria in those states. But the way she runs the business is very human. She thinks very deeply about the people who she's employed with, the communities they're selling into, how they do their business, and the risks they're taking, not just this quarter, but for the next decade. And so it's a very different mindset. Now, lastly, I just want to point out, all this means that you don't get poor quality companies when there's family involved. So
yeah, I was going to say, Nick, because I think if in the concept of stewards of money, I think the initial reaction, if you ask people whether family-owned businesses would be good stewards of money, I think they would say no. And maybe this has got to do with TV shows and stuff in the press. Yeah. But I think the initial reaction of most would be that family businesses aren't good stewards of money.
Yeah, and there's the old saying about the first generation builds it, the second does something, the third destroys it. We say out of the Indian market particularly is interesting because most of the companies are family led. Out of the top 100, there's probably 2.5 family businesses where we would happily invest in. We've been investing in India for 30 years. We've come across the Adanis, the Ambanis many times. We've never invested anywhere near them. We're very conscious of seeing evidence of who we're investing with. So again, it comes back to, it's a magic combination in a way of that economic alignment of families running business, along with integrity, competence, humility, ambition, and really strong signs of those. And the two need to go together. Otherwise, again, you don't want to go near them. And there are many, many family companies that go wrong.
Yeah, interesting. Now, just to pick up on I think it was the second slide, Nick, the fund held up amazingly well in that really tough period of time. And I see in the Stewart investment philosophy the concept that you believe capital preservation is crucially important for capital growth. And one of the things that we think is one of the defining characteristics of the fund is its downside capture. So when markets fall, it only captures 70% of the downside, which is great. Can you talk to us why the fund held up particularly well in that really rough month?
Yeah, sure. And anyone who's been to Scotland will know they have a reputation for being tight.
What do they say? Long arms and short pockets, and long arms, or long arms and short pockets, or something like that? I can't quite remember.
Short arms and deep pockets. We're always looking at what can go wrong. And we do that because of simple maths, in a way, that if something starts at 100 and it falls 50%, and it goes back up 100, you're not back to where you started. So in ensuring you don't lose money in strong down markets is actually incredibly important for compounding of returns. So how do we think about, well, what can go wrong? We look at three aspects of quality in our investment process: quality of management, franchise, and financials. So in quality of management, we're looking at people who are running a business for the whole cycle in mind. We're not looking at them running a business for the next quarter. And if you're running a business for the whole cycle in mind, you can see when markets are looking frothy. You can see when orders are changing. You can see when greater credit risk is being taken in your end market. We also look at quality of franchise, and part of this is about enduring recurring cash flows, business models that create effects that are resilient throughout the cycle. And we often talk about businesses that are in control of their own destiny, for example. They're not reliant upon either particular government regulation. They're not reliant upon commodity prices. Again, companies like Unilever have shown to have pricing power throughout the cycle in all types of market situations, and consistent growth because they're necessary goods. And then thirdly, we're looking at quality of financials. And here we look at being conservative generally, not aggressively cutting corners, not being aggressive with tax or with leverage in the balance sheet. So we're very wary of companies that have over-levered their balance sheet, for example, regardless of the price of money, because ultimately, when markets turn south, it's normally a fantastic opportunity for a business to buy competition. The last thing you want to be doing is turning up to a banker looking for more money or rolling over a loan. And so we would argue the portfolio held up quite well because of these quality attributes. And I'll just point out, I'll touch on some of the particular companies and areas. So we do have quite a few healthcare businesses in the portfolio. This is a bottom-up decision based on the companies they are. They're all businesses that are generally removing costs from the healthcare system, generally quite recurring in their cash flow nature. So DiaSorin, for example, is a fantastic razor blade style model around immunology and testing. And they're businesses that in the main generate high levels of cash flow and are generally quite cash rich in their balance sheet. So they've all held up quite well. Obviously, they got a great kicker in that we have this unusual global health pandemic. Secondly, we had quite a lot of investment in Japanese companies. Again, this was a bottom-up decision based on the companies they are. But Japanese companies generally are very cash rich. They tend not to get into debt. They tend to be businesses that, particularly export, are very, very good, because very few Japanese businesses actually successfully export. You know, we can all name some really big ones, obviously, that have been globally successful. There's actually not that many, however. And so if you can find good businesses that export out of Japan, they can often be very good. So we were in a handful of those, such as Unicharm, which is one of the leading personal goods sellers. So they sell a lot of feminine care products, a lot of soaps again and shampoos into China and throughout Asia. We're invested in Pigeon, which sells a lot of baby products into Asia. So again, ongoing necessary goods that demand does not tend to shift around based upon the economy so much. And then lastly, I'll just point out a couple of specific companies held up really well, and we would argue that they have particularly strong sustainability tailwinds behind them. One is a business in Denmark called Christian Hansen, which is involved a large part in it's a science business effectively. It produces microbes which help go in basically non-chemical based ingredients or additives for the agricultural sector and for the food sector. And so they enable, for example, both the dairy industry and certain cropping industries to use fewer chemicals and get decent yields. They enable us to substitute artificial chemicals out of a lot of our foods with natural ingredients. A business like that has actually done incredibly well during this period where people are focusing a lot more on their food quality and what they're eating. And then lastly, another business that we're investing in, Tomra, held up very well. This is a Norwegian business that has near on a global monopoly on reverse vending machines, which is a key part of waste infrastructure. In Australia, we have unusually good curbside waste infrastructure. That's not common throughout the world. Tomra have really sewn up a lot of the market in terms of providing waste infrastructure for recycling of bottles, tins, plastics, and the like. Here in New South Wales, we've now got their machines around as well, and they've actually had, even here with very good curbside recycling, they've had a significant increase in the recycling of bottles and plastics off the back of their machines. So, you know, just a simple tailwind that has strong long-term environmental benefits, but really not a large interaction with actual growth or GDP in the economy.
Interesting. Now, you mentioned Diasorin before, very topical stock, Nick, in the context of COVID. It's still your largest position in the portfolio at the moment?
Yeah, neck and neck.
So pretty keen for you to talk about Diasorin. And I guess we're probably keen to understand whether it was in the portfolio pre-COVID and what drew you to the business to have it in the portfolio in the first place.
Yeah, sure. And, you know, the reality is you get a lot of bad luck when you're investing. Sometimes it's nice to get some good luck as well.
Take the good luck when it comes, Nick.
Yeah, that's right. So we've been invested in Diasorin a little over 5 years. It's a business that's involved in immunodiagnostics. So they're basically trying to observe the reaction of antibodies to human samples to detect disease. So if you get some blood taken to detect vitamin D deficiency, all sorts of parasitic illnesses, flus, they run it through their machines. As it turned out, the bit of luck was that they were effectively the monopoly business for testing in Lombardy, which is the epicenter of the COVID outbreak in Europe. So it's an Italian-listed business. We were attracted to them because it really ticks all our quality boxes. So the quality of management was excellent. It started in the late 60s in Italy as part of a larger medtech business. In around 2000, there was a management buyout. There was a buyout with both management, but also some help from some investors, the Denegris. They had made their money through selling a business into basically into scooters, into Piaggio and Vespa and Aprilia, and made money that way and taken the money and invested it into a couple of businesses, including Diasorin. And so they own 44% of the stock. They're the controlling shareholder. Again, what we were able to see was since 2000, back in 2015, a fantastic 15-year track record where they ran the business really, really well. Nothing they did made really was a misstep. So the business listed to help some of the original investors get out. The family still own that amount of money. The CEO owns about, Carlo De Rosso owns about 8% of the business. There's been little change in the management who run the business. And basically it's a fantastic razor blade model. By that I mean the machines are about 10% of their revenue. The consumables are about 90%. And so pathologies, hospital facilities will buy the machine, and then they're continually ordering the consumables to run all of the tests. We know that pathology is a good business from a sustainability perspective. It tends to reduce cost in the system by identifying illnesses and problems earlier. As it turns out, as a sign of their quality, one of their larger businesses until a year ago was looking at vitamin D deficiencies. They're now actually, they became the first European certified business to do COVID antibody testing. And it's a business which really for around about a 10-year period has been able to grow their cash flows at 14% per annum, and continually the last 5 years produced a return on capital of around 60%. So they're now one of about 7 companies around the world that has COVID antibody testing. It's also going back to the governance and stewardship discussion we had. It's one of these businesses that does not meet what a person with a view of what perfect Anglo-Saxon government should be, which is one share, one vote. They actually have a long-term investor voting mechanism where if you own stock for over a year, you get 2 votes.
Wow.
We love this for 2 reasons. So again, it comes back to your question around families and the like. If we didn't trust this family running the business, if we did not trust management, this would be a problem. We would not be able to invest with them. Because we do trust them, we want them to run the business. We don't want the market to interfere. We don't want a corporate raider to come in and interfere. And not only that, we've registered all of our votes too. So our entire shareholding also gets 2 votes per share. So we're able to influence, we're able to build up a relationship with them. We speak to the CEO about every 6 months. We're able to talk to them about what they're doing, both in terms of ensuring the stability and the resilience of the business model with new tests coming on board through R&D. But we're also starting to talk to them about things around the design of the machinery and repurposing the machinery and taking it back and reconfiguring it, so they're reducing their waste on the environment. So that's, I mean, it's a great business. It's also been run very conservatively. Sorry, I didn't mention the quality of financials part. It's got a net cash balance sheet. The accounts are very straightforward. There's no related party transactions in and out of the family. It's all quite clean. So we think it's a very strong, resilient business that's done very well.
Yeah, interesting. It seems to tick all the boxes where you talk to that concept of stewardship. I'm going to jump across to another one, which I think is interesting in your portfolio because of its history. That's Unilever, Nick, and I think there'd be maybe a few eyebrows raised when we consider Unilever in a sustainable portfolio. Yeah. Not meaning to put you on the spot, but in doing a little bit of research for today, I found out that Unilever back in 2005, which is 15 years ago, was actually voted the equal most unethical company in the UK. So without putting you on the spot, I'm pretty keen to understand how that ends up in your portfolio and what's happened between 2005 and now.
Yeah, and probably deserved at the time, to be fair. Unilever is also pretty much the only company that most people recognise in our portfolio too. So we do get put on the spot about it quite a lot, which is very fair. It's 140 years old now. It's a huge multinational. Many people don't really understand the complexity of the business though. So more than 60% of its business is in the emerging markets. It's in the developing world. In the next 5 years, it will generate more growth out of Bangladesh than it will out of the whole of Europe. It'll generate more growth out of Pakistan than it will out of the whole of Europe. Its key brands, it has about 12 billion euro brands at the moment. which range everything from soap to detergent to bleach to tea. And so what, as you say, it has a checkered history. What changed? Well, in around 2009, a guy called Paul Polman took over as CEO of the business. He recognized the issues they had, and he began to unify the business under what he called the Sustainable Living Plan. It was a decade-long plan to run the business by removing the unhealthier food parts of the business and selling those parts off, by decoupling the environmental impact from the sale of their goods, by improving the livelihoods of people in which they sold into and the way in which they sold into it. And so what he was able to do was really unify the company around this calling card of making them a really genuine sustainable business. And you'll find that today they're actually held up as an amazing sustainability leader. So how do we get confidence in that? Well, they've now rolled out, they're the biggest seller of soap into the emerging markets. They've rolled out a hand washing and sanitation campaign to 1.2 billion people around the world. Now, it's easy to forget that over 2 billion people have lack of access to safe water supplies. Over 2 billion people lack access to any ongoing, reliable and healthy water service. 900 million people still openly defecate out in fields, and 4.5 billion people lack safely managed sanitation. So their impact in, and the WHO has recognised them in what they've done, their impact in reducing diarrhea-related deaths in under 5-year-olds in the emerging markets has been huge. The way they access and sell into markets we like as well. So instead of selling their products in through big box stores, large multinational retailers, just to give you one example, in India they set up what's called the Shakti Amma program, where they reached out to several million women, gave them bookkeeping courses, some basic skills in running a shop, and enabled them to set up small stalls out the front room of their houses and sell into local villages. In addition to that, they've been champions in smallholder agricultural projects throughout the world, particularly in Africa. They've been fantastic in moving the tea market in Africa towards plantation owners and small-scale farmers receiving fair wages and accessibility to market. One area is still a vexed market where they still get a lot of bad press from NGOs is the palm oil market. Palm oil is an incredibly dirty industry, which is in a very, very slow process of being cleaned up. It's been hamstrung by a whole range of issues. Some of it is the buyers. It's been driven largely through poverty alleviation, where people living in poverty are burning marginal lands to grow soy crops. It's being helped on by complicity from governments, including Malaysia and Indonesia in particular. But Unilever is the company that consistently comes up as the one making a stand in our viewpoint. They've committed to buying more certified sustainable palm oil than anyone else. When on 2 occasions in the last 5 years, palm oil suppliers have been benched or have run into trouble with authorities, we've gone to speak to them to find out who's made the biggest noise and who's forced them to change their practices. Both times they said it was Unilever. And then lastly, in terms of their own business, the way they promote people has been fantastic. So one of the things Paul Polman said he was very proud of was back in 2009, women in management were around 14% of Unilever. Today, they've almost hit 60% in middle and high level management within the organisation. And this is a multinational that is all around the world, serves over 1 billion people a day, with several 100,000 staff. And again, most of those in poor and developing nations. So what I also want to point out is there are no perfect companies. None of them on the stock exchange are perfect. They all have their problems. So we've been talking to Unilever for several years about palm oil, encouraging them to improve. We think the direction of travel is good. strong. We do think they're leading the way against all their peers, but it will still take time. We also, they have additional problems that we've been talking to them about as well. There's parts of their portfolio that are still unhealthy. They still sell ice creams. They claim it's a treat and it shouldn't matter, but the way they sell them can be improved. And then lastly, there's some may or may not know, there's an enormous market in Asia for skin whitening cream for women. And it's sold as basically a route to progress. And we've been talking to them for 8 years now about changing the messaging and the branding, let alone the ingredients of that product. Others have fallen foul at different times. There's a business in Japan that had a problem with bleaching women's skin. And we've been pushing them hard on that for many years, and they've only just finally moved. So they've been disappointingly slow in that respect. But there's a whole range of areas we're engaging with them consistently to try and improve. And I have to say that in many, many ways, they do really change system-wide how things are done. I think particularly on the agriculture and small landhold scale in the developing world.
It's pleasing that you use your place on the share registry to influence change, Nick. Now it's crystal ball time. This is always the most fun part of the presentation. We know you're a stock picker, but it wouldn't be a webinar without some sort of outlook for markets and the world. So as best as you can in the environment, Nick, can you give us a sense of where we are and how you think things will play out over the next little while?
Yeah, sure. So I think there's about 5 minutes. What I want to do is just quickly touch on 5 things, which won't give you a definitive answer, but will very clearly show you how we are thinking. The first thing is it looks like we're potentially at the beginning of another Cold War. It certainly feels like that. We're seeing we're seeing strong incursions on very large businesses on the technology side. The whole Huawei ecosystem's just been taken on by the US. There's likely to be reprisals of some sort. We're several years into a very strange stop-start trade war. It's difficult for us to see this changing anytime soon. And with that, what we've seen is incredible disruption to supply chains and trade, and obviously end markets on the demand side. So it's, you know, this is quite worrying from an economic perspective, if not more than that. There is a major geopolitical tension going on, which has financial markets implications. The second thing is an observation, excuse me, observation of the last 20 years, which has accelerated in the last year. And that's around how companies are using their cash. So if you look at around 1960 to 2000, on average, CapEx and R&D was about 20% of company investment. If you look at the last 15 years, that's fallen down to 10%. So the productive investment into the economy, or investment into a productive economy, has dropped off significantly. What has happened? Well, a lot of that cash has gone into financial engineering, and it's gone into financial engineering because of, I guess, the benign growth we've had in recent years. And so if you look at, and this has really been accentuated the last year or two, but if you look at where money supply is going today, the last year in particular, all of the money printing is going into chasing financial assets. It's not going into the real economy. Financial engineering appears to be the order of the day for companies, and it's not hard to look at things like the US equity market since the GFC. And when you look at the largest buyer of equities, it's not institutional investors like us. It's not governments or pension funds. It's been US corporates. They've been the largest segment of equity buyers on the US market. The third thing I'll touch on is governments controlling the price and the quantity of money at the same time, which is what's happening now with both interest rates and bond market and money printing. Public debt levels have never been higher. We've just taken over where we were in World War II. The end of World War II. The end of World War II, as many on the call would know, was a huge demographic shift. You know, huge amount of people born. growth, optimism, new technology, rebirthing of economies, waking up from a war period. We've hit that period on debt now. I'm not sure where that strong growth in inflation comes from, because it feels like we're in a very different place. And then on top of that, it appears we've got to a point in time where corporate tax is optional. And so tax rates are what governments want to, what companies want to pay. They've never been lower in the US or globally for that matter. And so what are we saying to future generations and for our economy for the next 10 and 20 years when we have debt levels where they are, very little sign of growth and inflation, and no real tax coming in? That leads me on to the fourth point, which is demographic change. We're probably in a similar point in history as 1968, where a new generation is about to take over as the largest segment. And that's what some people refer to as the Gen Z, or the millennials are about to take over the boomers. They're different. The shift in the inflection point in the 60s and 70s was one of, moving into Reagan, Thatcher, Milton Friedman, around corporate profits taking off. We've got a group of people who are worried about affordability of housing, more so than ever worry about their careers, because they see AI and technology disrupting it, and a very mobile global planet. And they're worried more and more about companies in their environment. Where our level of debt is borrowing from this generation. We're seeing popularity of people like AOC and the young senator in the US, and then in the other extreme, Bernie Sanders in reasonable popularity. But there's a different focus on younger people now. And I think that will play through to a trend on economics, and perhaps even how the private and public sectors work together going forward. And then fifth, the last point I just want to touch on is valuations and earnings. What we've seen this year is a $27 trillion market collapse, followed by a very swift $27 million market correction. At the same time, company earnings, we just saw last quarter, company earnings have fallen by about 33%. GDP has fallen through the floor. We've got many millions of people unemployed. And it's been translated through to companies where, if you look at the world's second largest company, which is Apple, obviously Saudi Aramco is the largest company in the world listed. In the last 4 years, Apple, their share price is up 350%.
I heard the other day that Apple's got a market cap that's greater than all of the German stock exchange.
It's nuts. Their income has fallen 5% in the last 4 years, while the share price has more than tripled. Their debt is up 94%, and their share count, so their buybacks, is down a quarter, down 24%. And this should be a concern to people. At the same time, what are termed insiders or company executives have sold more than $50 billion worth of shares since the start of May. August was the third month out of the past 4 where excess of $15 billion has been sold by insiders, and this is the fastest pace we've seen since 2006. So what I would say is there's a confluence of both shorter term and perhaps more structural longer term effects at the moment that have us a little bit concerned about where we see the market today. Interesting.
Well, thanks for your time, Nick, and for the insights on behalf of our clients. Congratulations to you and the Stewart team for the performance of the fund in recent times. It's to be commended. To all of our clients and guests, thanks for dialing in. Stay safe and well, and we look forward to speaking with you all soon. Take care.
Thanks very much, Patrick.